So before we're gonna kick off,
Yeah.
um, one thing I still am not really sure of
Yeah.
is what was the need to use CTD?
The need to use CTD.
You forgot. Can you help me out?
No, no, no. I remember. It's to maximize your profit or loss on settlement.
Something I forgot. I want you to help me.
Yeah. So it's basically like, suppose you're long, you have a long position, especially in like fixed income. Um, you want to hedge your position, so you have to short a sort of futures contract. And what happens is, because bonds especially are illiquid, you may not get the perfect hedge. And in order to determine out of this hedge that you get into how much maximum profit or minimum loss you'll make, the optimal bond to choose is the cheapest to deliver bond.
Very good. Okay. That's great. And then I also want to know when I'm gonna do this, what's my profit or loss? Obviously, when I'm going to do this, then I will have to, I'm going to get some money,
Yeah.
which is going to be my future
Settlement price.
settlement price multiplied the conversion factor
Yeah.
plus
Accrued
if
interest.
there is any accrued interest. This is something that I'm going to get.
Yeah.
And I would also be giving away. So I'm subtracting.
Yeah.
I would be giving away the CTD bond.
Yeah.
So basically the CTD price, right? Plus accrued interest.
Yeah.
So when I'm using the word accrued interest over here, I'm assuming that this would be a clean price, right?
Yes.
So basically, the idea is that I'm using the price of a CTD bond,
Yeah.
right? Which is going to be the dirty price, effectively.
Yeah.
And lastly, we also understand that this future settlement price is effectively on per par,
Yeah.
right? Which means you will have to
Divide by
effectively,
100.
yeah, either divide by 100 or
Multiply by
effectively
100.
multiply by 1000,
Yeah.
right? Because it's going to be divided by 100
Yeah.
and then multiply by 100,000,
Yeah.
right? Last one thing is that we know that in case we wanted to calculate, and this is, you're gonna get a lot of questions on these things, was, and then I'll show you that how I'm changing the formula here and there, but the basic structure of the formula would still always be the same, is the number of contracts that should be bought or sold, right? Or I
Yeah.
would call it as a.
I had one question. Yesterday you mentioned that basis risk is, if I'm not mistaken, like spread risk. Is that what you said?
Yeah.
So I thought we were, like, in basis, we're always evaluating like 1 bp change in
Right.
the interest rate. So how is that related to spreads? I thought spreads was basically something that is over the, say, the treasury rate, right? That's what I used to think about spreads as. So how are those two the same, or they're not the same?
Okay. So when you said spread,
Yeah.
what does spread mean?
It's effectively the differential between the interest rate, say, for a corporate or
Very good.
any
No,
other
no.
bond.
All I want to know that the spread is a difference.
Yeah.
I want to earn the spread. It
Yeah.
means a difference between some high amount minus a
Yeah.
low amount,
Yeah.
right? So in in the CTD bonds, when you calculate the number of contracts
Yeah.
and you get a value which is something in points, right? And you are not able to hedge it completely. It means there is some kind of a basis risk or a spread risk. Now,
Okay.
the idea here is not to tell you that there is a difference in the interest rates, but to tell you that there is a difference on what I should hedge versus what I'm actually hedging, and hence the word spread.
Got it.
Right? And then again, this spread risk is also called as basis risk, because ultimately you have to adjust your price or your number of contracts by a few bases to hedge that. And while you're not able to do so, it is still called as basis risk.
Got it.
So what I was saying is the number of contracts that I need to buy or sell would be given by the BPV of target minus the BPV of portfolio divided by the BPV of CTD multiplied conversion factor. And indirectly, this is actually going to, you can say that this is my modified duration of the target.
Yeah.
Multiply 0.01% multiply market value of the portfolio. This is going to be my modified duration of portfolio multiply 0.01% multiply market value of portfolio.
Yeah.
Right. When it comes to this, similarly, modified duration of CTD multiply 0.01% multiply the market value of CTD, and inherently this will be given by the CTD price, right, by 100 multiply 100. So if you know this, you're sorted. In case they don't talk about target thing, then this value turns out to be 0, the whole thing. And hence you would say that you will effectively be selling the contracts.
Yeah.
The value will then be negative. Okay, all good?
Yeah.
Now let's just quickly one thing, not sure whether you're doing this or not, but maybe if you have a notepad or somewhere,
Yeah.
whatever formulas that we discussed, just keep writing somewhere.
I do have all of. I just need to consolidate them, but I have.
Okay. So we covered so far is FRA.
Yeah.
And then we talked about a normal swaps. Then we talked about fixed income futures. Talked about SITR. Right.
Yeah.
Now let's just talk about currency swaps.
Yep.
You can imagine that the concept would still remain the same because of the name, because of the word swaps. You are again exchanging something, but this time what exchange of the currency, right? But the question becomes, my first question is why? I was okay to understand that I was trying to hedge my interest rates.
Yeah.
Not really hedge, but to lock in the price. Right?
Yeah.
Why? Because I was not sure. I discussed the case with you that my paperwork is still going on. I have to buy some machines and I want to get some loan, but this paperwork is going to get completed in another 2 months. But I think that the calculation that I'm doing with the current interest rate works for me. But who knows what the interest rate would be after 2 months? So I want to lock in that interest rate for future.
Yeah.
Hence, I got into some FRA. Right? And then I got scared because I thought the interest rates might go down. I got scared and I thought that it is, I want to get a fixed, I want to pay fixed if the interest rates go up in future, I believe. So I want to pay fixed and vice versa. So I got into fixed to floating swap, etc. And then when I thought that it is difficult to manage the interest rate for a bond portfolio, then I thought about FI futures. Right?
Yeah.
And for short-term futures, we talked about SITR.
Yeah.
So why do you think I would be using currency swaps? What would be the need?
Is a carry trade part of why you use a currency swap?
Okay. Carry trade.
Where
Just a
you
heavy. Mhm.
where you borrow instead of Japanese yen because it's cheaper, you invest in something that's more high yielding. Is that maybe when you use a currency swap or no?
You are a you are living in India, right? Which city? You live in Mumbai.
Mumbai.
So you are based out of Mumbai. And tell me something. Do you really think about do a carry trade in yuan or yen or GBP?
No, no, no. So
If you
okay,
are investor, maybe. Mhm.
maybe maybe you're
Mhm.
a large conglomerate. Uh,
Okay.
you have operations. Suppose you're based out of US, you have operations in India, for instance. Um, I think essentially you earn profits in India. So you're earning in INR, but um, I guess when you're getting it back, you're scared of the depreciation that could happen on the INR. But then you just use the future. Yeah, I'm not sure.
Okay. Okay. So the simple thing is, how does our Indian banking system work? So when you go and ask for a loan, right? They check your
Yeah.
CIBIL.
Yeah.
They look at your background. They look at your source of income. They look at your authentication, Aadhaar card, PAN card,
Yeah.
and then they do processing, and then they provide you the loan. Now you are an Indian citizen, and you are thinking of setting up some business in US, maybe,
Yeah.
right? But you don't have any existence over there for now,
Hmm.
or even if you have existence, people don't know you much.
Hmm.
I'm sorry. Then what happens is, let's say you would want to get some money in dollars,
Mm-hmm.
right? It is very difficult. Now, when I'm saying
Yeah.
it's difficult, it's not difficult operationally, but obviously you mortgage something over here in India
Hmm.
to get the loan, right? Let's say you don't have anything to mortgage in US, and in case you default, what will they take from
Yeah.
you,
Correct.
right? So the point is that if you can comparing apples to apples, I'm not really take care of exchange rate for now, but I'm saying let's say the interest rate that you would be paying to get 100 rupees in
Hmm.
India, and if the interest rate that you're paying is 5%, to get same 100 rupees in US, assuming currencies are all same, you will have to
Mm-hmm.
pay 8%, right? The idea is simple because they perceive more risk in giving you money,
Yes. Yes.
right? Obviously, if a Japanese person come to India and ask for a loan, probably they might not even issue a loan to him, or maybe they
Mm-hmm.
charge a lot of interest rate,
Mm-hmm.
right? So that becomes my motivation of going through the banking system, which will take a lot of time, and then the interest rates would be too high.
Mm-hmm.
How about that if I can find a swap dealer maybe
Mm-hmm.
first, or maybe even better than the swap dealer, somebody who is having its operations in India but from the US.
Yeah. Yeah.
Nothing like it. It's like a win-win for him because
Yes.
he will find it expensive to raise money in India, and we will find difficult to raise money in US. So how about that he'll give me money in dollars, and I'll give him money in rupees, and he can spend in rupees, and I can spend in dollars.
Yeah.
Can you see the motivation here?
Yeah.
Right? So assuming you don't find another counterparty asset, but then let's just assume that you have a swap dealer,
Yeah.
right? One thing that I want to mention that in everything that we discussed so far, we talked about netting.
Yes. Yes.
That we looked at the settlement date, whatever it is, we just exchange the money, right? And then we do a netting.
Mm.
But in currency swap, one of the most important things that we need to understand is that the notional principal is exchanged
Mm.
both at initiation and expiration of contract. And the reason is very simple. Reason is very simple. If I have to convert my 85 rupees for $1,
Mm-hmm.
I will have to exchange, I have to give away my 85 and take $1 at the starting.
Mm-hmm.
And we'll talk about what will happen in between. But at the end of the duration, at the end, I'll again have to get back my rupee and give away dollar. Does it make
Okay.
sense?
Yeah.
Since in currency swaps, two currencies are being utilized, hence the notional principal will be exchanged at the initiation and the termination or the expiration of the swap.
Got it.
Right? Now, when it comes to payments, right? So the how it works is, this is Ankur and this is Shyam. In this case, Ankur is giving rupees and Ankur is getting dollars. Now, this happens at the initiation. Since
Mm-hmm.
I have got dollars, I will be doing, let's say it's a quarterly payments. So I will be doing the quarterly payments in dollars, not in rupees. Remember this,
Okay.
right? Since this person has got rupee in hand, he will be making payments in rupees, quarterly payments,
Hmm.
right? And at the end again, we will exchange the notional principal and use it.
Hmm.
Is that okay? Right? Since we did not go through a standard procedure of going to a bank and raising the money, this
Yeah.
concept is called as synthetic swap. Sorry, synthetic borrowing.
Got it.
Obviously, we're not borrowing from the bank, but we're doing this kind of
Yeah.
arrangement called as synthetic borrowing.
Yeah.
Right? Just allow me 1 minute. I want to see a name. Actually, the person who, let's say Ankur, is paying quarterly payments in dollars.
Mm-hmm.
So there is a name that I would be called as dollar paying or something like that. There is a name. Just hold on. Let me just check.
Yeah.
Um, should be called something. Huh, yeah, okay. So I will be called as a dollar payer,
Got it.
and he will be called as a rupee payer. So the point that I'm trying to and the point I'm trying to make over here is that although my original currency was rupee,
Yes.
still in currency swaps I will be called as a dollar payer because effectively the quarterly payments that I'm going to make is in dollars. And this part is testable in the exam. So one thing is, again, before we go to a question, the takeaways are that in currency swap, exchange of notional principal happens.
Yes.
Both at initiation and termination of the swap. Second, the the word pair is used as per the quarterly or basically monthly or basically semi-annual payments. And third, netting not possible. Is that okay?
Yeah.
I write those in the points because these things are tested in the exam somewhere here or there.
Got it.
Also, obviously, you would know that when I say that I have 85 rupees and I would be exchanging by $1, so I'm assuming that we looked at the exchange rate for that time and then we did the exchange. Right? So in a way that I'm saying that if I have to raise, the idea is that if I'm Ankur and I want to raise money in dollars, so I would then be thinking, okay, how many dollars do I need? How many dollars do I need? And what is the exchange rate? So accordingly, I'll put my INR in such a way that I get effectively those many dollars in US.
Can you repeat
Make
this
sense?
point?
Yeah,
Could you repeat?
I'm saying if I'm in India,
Yeah.
and I effectively want dollars,
Yeah.
and if I want $100,000,
Yeah.
so I look at the exchange rate,
Yeah.
and
Yeah.
I would put my money, my INR in such a way that I'll get $100,000.
Correct. Yeah.
Right? Because obviously my objective is to get the dollars, and depending on
Yeah.
the exchange rate, I can convert accordingly.
Yeah.
Right? One more thing that people talk about, and then you will get questions on it.
Yeah.
That the questions might also come that I want $100,000, right? And I'm going to go through a swap dealer. And according to the exchange rate, I know for $100,000, I would require 8,50,000.
Yeah.
I would require 8,50,000. But
Yeah.
obviously, I don't have money. Effectively, I would be raising it from the bank in US.
Yes.
Right?
Yes.
And if it is not possible, I'm going through a swap dealer.
Okay.
But then what I can do is I can raise this money locally.
Okay.
So what I
Yeah.
can do is I can go to a bank. I can raise 8,50,000 at the rate 5%.
Yeah.
The bank will give me this money, right? I'm using the word as X. I'll give this X to him, right? Now, what happens is every quarter he'll pay. Obviously, he'll pay me dollars. He'll pay me dollars, which is 100K. Now, every quarter, he'll keep on making the payments in X, some percentage of X, right? Whatever we would decide.
Yes.
As I said, since he received the rupee, he will pay me in rupees.
Yes.
So he will keep on making quarterly payments in rupees. And obviously, I will have to also pay the EMI.
Yes.
There will be some kind of a difference, right? If I would be raising at 5% over here, the swap dealer will be giving me at 4% maybe. Because that's the spread that he's going to charge. right? Because he will also decide some quarterly payments, right? So let's say he is giving me at 4%. I will be taking at 4% from him and giving it away to the bank. Those EMIs. Does it make sense?
Yeah.
Shall I repeat?
No, makes sense.
So effectively, I am down 1% for now, right? Because I'm getting it at 4% and I have to pay at 5%,
Yeah.
right? And now I also have dollars. I have to pay him in dollars, whatever the interest rate would be, right? And then I can calculate that how much of the interest rate I would effectively pay in this whole synthetic loan.
And one thing, the differential you said arises because does the guy the interest rate for him is like, is the differential between the nominal rates of the economies, or it's because he's not a US resident? Like I understand that this is, it will be lesser than what it would be if he had to borrow in the US, but there will still be a differential, is it?
So I'm saying for now, leave US.
Yeah, okay.
For now, leave US. Just think about these green lines.
Yeah.
So what I'm trying to say is that if I raise the money at 5% from the bank
Correct.
and then give it to the swap dealer,
Yeah, this ends. Yeah.
right? When the swap dealer is going to pay me
Yeah.
as a quarterly payment, he would obviously, again, the questions would be different, but I'm saying in a usual scenario, the swap dealer would be paying me less. Let's say there are no other transaction. Swap dealer would want to charge 1% for himself, right?
Yes.
That's the reason I'm saying it could be less than the what you're paying in the bank.
Oh, understood.
Right? It has nothing to do with the purchasing power parity or the differential in the interest rate, etc.
Yeah.
Right? And the question might come up that the swap dealer is also paying you 5%. That's fine. Okay.
Yeah.
And one more thing. Yeah. So the question might come up that in this arrangement, because Ankur, who has raised money from the bank, and given it to the swap dealer, and swap dealer gave me in return these EMIs, and I am down 1% effectively, and then obviously I will have to pay something in dollars.
Yeah.
Right, and then that will also incur some cost to me.
Yes.
And finally, I'll exchange the currency at the end. So I'm saying overall there will be some cost to me overall of borrowing.
Yeah.
Right. Effectively, that I would be paying this much, that much, and then I exchange whatever it is. It will effectively, when you do end-to-end transaction, you can understand that you can try that. Okay, I started off with 850.
Yeah.
And I end up paying 9 lakhs rupees effectively, all inclusive.
Right.
So you can say that okay, my cost of borrowing is this much.
Yes. So it's effectively higher than 5%.
Obviously, it will be higher than 5%.
Yeah.
Right. But then you will then think that had I have to borrow it from the bank directly, it is going to be this much rate.
It would have been more.
So I'm saying whether you exchange it from the bank directly versus you do the synthetic swap, you get questions to contrast that how much my cost of borrowing would be in the two scenarios. Make sense?
Yeah.
Okay. And the most difficult question that you can ever get in these things is that when the currency also plays its own role.
Currency also plays a role.
Okay. That at the initiation, this was the currency rate, and at the termination, the currency rate was that. That's the maximum that you can ever get in currency swap. So I give you different scenarios. Whatever question that you get will be a subset of what I just explained. But that's the maximize, that even in why I'm calling it as a maximized situation is because you are not using your money in this case. So you are borrowing from the bank in India.
Yeah.
Right. So there could be one question that is only related to this. Right. there could only be a question that could be related to this.
Yeah.
And then I'm also looking at FX rate involvement as well. That's the
Yes.
max that you could ever get in the exam. You will not get any question about that. But the only way to solve this is we should go one by one. Let's look at this loop, keep it aside. Let's
Yeah.
look at this loop, keep it aside. And then look at the FX rate and then do a plus minus at the end. Are we okay?
Yeah.
Just solve a couple of questions to understand if you're okay with the concept. Let's look at this one.
Euro-based company requires USD but does not have access to USD borrowing or finds it prohibitively expensive. The company said borrow in euros at a 3-month euro reference rate and intend to a cross-currency swap basis USD based on the 3-month USD reference rate, a floating swap. The swap has a tenor of 2 years with quarterly settlements. The principal is used 50 million and the rate of initiation of the swap is 1.
Let's just, before solving this, let's just try to understand what's going on here. So basically,
So
I
he,
replace.
I can try and do this. So he's a company. He from the local European bank. He's borrowed 50 million euros, and he's borrowed it at the euro reference rate. That 50 million he exchanges, say, with a swap dealer for 50 divided by 50 into 1.1236. So he receives that many dollars. He receives that many dollars. Every quarter, the European guy has to pay the USD reference rate, and every quarter the swap dealer has to pay like the maximum of the euro reference rate, or the minimum of US reference rate, or like if he's taking a cut out of it.
And finally,
so finally, sorry, what? Finally, so finally in the end of 2 years, they have to like in the end of 2 years, the swap dealer is given USD. This guy is given swap dealer will have to return back whatever 50 million euros is into the exchange rate at the time.
which is same over here in this case. In this case, they only use the same exchange rate, right?
Yeah. So then it's the same, and then the Eurobank has to deliver the same notional back to the swap dealer, which is 50 into 1.1236.
To understand the whole thing, right?
Yeah.
Okay, let's just try one more question with some actual calculation so that you would know how things are moving. Yeah. Get your pen and paper. Have you got the calculator today?
No, I haven't. I'll get it. Borbes patisserie.
But by the way, do you have it or do you have to buy it?
No, I have it. I just haven't taken it out. No, wrong word. But I'll have it for tomorrow's class. Borbes patisserie is a French chain of
We'll have to write a lot of things in this.
Yeah. I am doing exactly that.
5 minutes.
Yeah. So the first part is principal at the start. So he wants about $50 million. So he has to exchange. Yeah. So he will exchange. The notional exchanges are this company will give up 42.3 million euros. and receive 50 million USD. So that's the first part of the question.
Okay. So keep
Second
telling me
part
the
is,
amount. So like, keep
pardon?
telling me the amount. In terms of euros,
Yeah, so in terms of euros, it's 42.3 million euros. And USD is $50 million.
exchange is done. I understand that. And then what happens on the quarterly payment?
Yeah. So the interest payments at the first and second dates, they've given only initiation and first settlement date. So how come they talk about second settlement date? Okay, anyways, I'll calculate for the first. 3 months later. Oh, okay. Same mistake.
That becomes your second settlement date, right?
Yeah, same mistake. 3-month euro reference rate is 1.5%, and so for the first one, and US reference rate is 2% at the swap initiation. So yes,
So this 1.5 and 2 is as of today, but will be used for the
yes.
first settlement.
Same mistake I missed in 60 bips. So 1.5% plus 0.6, which is 2.1%. He has to pay in terms of euros. So the swap dealer will pay him basically, since it's minus 20 for the basis points being quoted. Swap dealer will pay him about 1.9%, right? Is what the swap dealer will pay him. He has to pay US reference 1.9 plus 100. He has to pay 2.9% to the swap dealer. And effectively then, so he receives only 1.9 but has to pay the European bank 2.1. He pays this guy 2.9. How do you then calculate the cost to Bovis for its synthetic dollar loan?
So this is what I'm saying, right? Just go step by step. I understand the principal flows that you talked about, right? That for 50 million, how much euros
Okay.
are we going to get?
Got it.
Then
So,
I'm saying just write this down that the person, let's say Boivis, right, who is European guy, and then the swap dealer, create a box on your sheet and then say that since he has got the dollars, how much he's going to pay,
okay, cool.
and
So
obviously
that I
he'll
can
have to pay.
that I can do.
That will give some clarity.
Yeah. So he has to pay 2.9%. 2.9% on $50 million. 2.9 divided by 100 divided by 4 into 50. So he has to pay to the swap dealer 362,500. Just give me 1 second. So open it. Yeah. So he has to pay $362,500. He receives 1.9 divided by 100 divided by 4 into 42.
Just solve this question. I'll be back in 2 minutes. Okay.
Yeah.
And obviously I'm gonna come back and discuss on every box. So rather than netting, just let me know how much he's going to pay in dollars, how much he's going to pay in euros, how much he's going to receive. I'll back in.
It's 50 million. Okay. So let's just do the first settlement date. I didn't have time to do the second.
Yeah.
Second.
But before that, let me quickly read the question and draw
Yeah.
so that you will know which leg are we talking about. So Bovis Saal is a French owner of this that has extensive network of shops in continental Europe. As a part of expansion, they are looking to set up shops in the United States. Bovis estimated it will initially require $50 million to set up shops and cover working capital requirements. And he would be requiring $50 million.
Yeah.
The finance directors of Bovis have looked at directly borrowing USD, but have found that the cost would be US dollars reference rate plus 100 bips. So just in case he doesn't do a swap thing, then this can do from a bank at LIBOR plus 100, right? This is like the direct thing where no swap dealer is involved. Is that okay?
Oh, I see. Okay.
Right. It says, right? Sorry. It just says the finance directors at Bovis have looked at the directly borrowing in USD, but have found that the cost would be the US dollar reference rate plus floating. The decision is made to borrow for 4 years in euro at a rate of but the decision is made to borrow in euros.
Yes, this I understand.
The decision is made to borrow for 4 years in euros at a rate of euro reference floating rate plus 60 bips. So basically, the time is 4 years. So they say that they can go to a European bank.
Yeah.
This is actually US bank. They can go to a European bank and they can borrow at euro reference rate plus 60. So euro reference rate plus 60. Okay?
Yeah.
With interest rate quarterly. So interest rate paid quarterly. So basically, whatever he will pay them the rates in quarterly. And enter into a currency swap to exchange euros for dollars. Basis on the euro dollar swap is being quoted at minus 20 basis point.
Yeah, I think this is the part maybe I didn't understand fully. So
basis on the euro dollar swap is being
yeah.
quoted at minus 20 basis point. So basically, this is the swap dealer.
Yeah.
He will give money to him and he will receive something from the swap dealer. Right? Now, when they say that the basis is minus 20, what does that mean? It means that whatever the prevailing rates would be, he will pay you minus 20 pips. Right? Whatever the prevailing rates would be, he'll pay you 2%, 20 pips less than the prevailing rates.
Yes. Okay. Yeah. Correct.
Basically, the euro dollar swap is being quoted at minus 20 basis point. Okay. It means, as I said, right? Remember when I said he'll pay 5%, but then he will receive 4%. So to the bank, if he will have to pay 5%, he will receive from the swap dealer at 4%. Did we discuss this before?
Yeah.
And then you said, what is this 4% versus 5%? And I said, obviously, swap dealer is also going to keep some money with himself, right?
Yeah. So I
For
thought
the
it would
exchange
be euro plus 60 minus 20.
So this is a different leg. We'll talk about this. Euro plus 60, he borrowed from the bank. Right? And we'll see. He will have to pay euro plus 60 to the bank in quarterly terms. But then what he's going to receive will be whatever the euro reference rate would be. He will receive less than that 20 pips on quarterly terms.
I see.
Right? And then it says the swap pays variable interest on both the legs on quarterly basis. The current exchange rate is 1.1815, which is dollar by euro is 1.1815. Right? It says the
Yeah.
3 months euro reference rate is, so E here in this case is 1.5 and U in this case is 2%. Okay. Let's talk about the other things later. So let's go one by one. सबसे पहले, what will be the initial exchange? Let's talk about at initiation. At initiation, so basically 50 million, right? And then you divide it by 1.1815, right? Do you know why I'm doing this?
Yeah.
This is going to be, you told me, right? It is going to be euro 42. I am giving you the exact number 42319,086. So can I say that he will have to borrow this amount from the bank? Is that correct? Remember when I told you that he will first decide how much money does he want in the foreign currency, and then depending on the exchange rate, he'll convert it back to his local currency and then borrow that much amount from the bank.
Right.
And I gave you an example of 8,50,000. So how did we arrive at 8,50,000? I would want 100,000 US dollars. Current rate is 85 rupees. So I said, okay.
Yep.
All right. So what I was saying is that, so you remember the case when I said that he will, how much ever money that he want, in this case, it is $50 million. He will actually look at what would be the exchange rate and then borrow that much amount from the local bank. Is that correct?
Yeah.
Okay. So keep asking me questions if you're not sure. So effectively, can I say that he is going to borrow these many euros at the rate of UE plus 60?
Yes.
Right?
Yes.
Look at this line. When it says that the decision is made to borrow 4 years in euros at a rate of euro reference rate plus 60 bips with interest paid quarterly.
Yeah.
Okay. So we'll talk about the next leg, which is how the transaction would happen with the swap dealer. But currently, I really want to focus on this leg. I'm calling it as A. And let's just call this leg as B. All right. So let's just talk about, when it comes to leg A, how much Bovis has to pay. So can I say that Bovis will actually have to pay interest on 42319,086, right? Multiplied what rate of interest?
2.1% divided by 4.
How 2.1?
1.5% is the euro plus 60 bits.
Okay, correct.
Divided by 4.
90 by 360.
Yeah.
Is that okay?
Yeah.
So this is fine. Now this is something that he's going to pay.
Yes.
Now let's just talk about how much is he going to get from the he will have to also pay in dollars, right?
Yeah.
So on a leg B, he will have to pay in dollars.
Yep.
How much that is going to be?
That'll be $50 million into 2% plus 1% into 90 divided by. Huh?
No. One second. He entered a currency swap to exchange euros for dollars.
Yeah.
Right. And basis on the euro dollar swap is being quoted at minus 20 basis point. Right, which is on the reference euro rate, but he is going to do a currency swap euros for dollars, which means, so when you say that it is US dollar plus 100, this this transaction is happening when he's going to do directly from the bank.
Got it.
Right? But here he is going to give away the US dollar rate, but he is going to receive the Euribor minus 20 pips.
Yeah.
Does it make sense?
Yeah, that's clear. So he's paying only USD rate, is it?
He's paying only USD rate.
Yeah, okay. Then it's only 2%.
But so effectively, when he's paying the USD rate, he should be getting the Euribor rate.
Yeah, but he's getting minus 20.
But he's getting minus 20. Okay? So it is explicitly written in the question, no assumptions made.
Yeah.
Okay. So can I say that he will be paying 50 million multiply 2% multiply 90 by 360, whatever.
Yeah.
Is that okay? So this is something that is being paid.
Yeah.
Now let us talk about what he's going to receive. Am I not paying this? Go base is not, isn't he paying on dollars? Right?
Yeah.
So he's a dollar payer, isn't it?
Correct.
Bovas is a dollar pair. Now, how much he is going to receive? He is going to receive on euro 42319,086 multiplied 1.5%, right? Minus 2 bips.
Yes.
Multiply 90 by 360.
Yes.
Correct? Now, let's just talk about, now that we are sure about how much he paid and how much he received. Important thing to now notice is how is the transaction look like? Transaction as in the overall transaction look like.
Yeah.
How about that if he would have to do this directly? Let's just check. And then we will see how much effectively that he paid or received. And is the cost good or bad? The cost of financing directly would be how much? 50 million multiplied. What was the US rate? 2%.
Yeah.
This US rate was 2%, and then it was 1%. Multiply 90 by 360.
Sorry, why are you doing this part?
So I basically want to gaze that
Okay,
how
got it.
much had I do it directly versus I
Yes,
did a
yes.
synthetic, which
Yeah.
one is cheaper for me?
No, makes sense.
So this is something that he could have done directly,
Yeah.
right? This is something that is being directly versus the cost of synthetic borrowing.
Yeah.
Let's just do that.
Yeah. So he had
Overall,
to
if you
375,000 he'd have to pay if he was borrowing directly.
sorry, come again.
He would have to pay 375,000
Right.
for the if he had to
In
borrow
this one.
directly.
Yeah. So this is $375,000, right?
Yeah.
Okay. And how much he's going to? What is the cost if it was synthetic borrowing? So let's just look at this.
Yeah. Yeah.
You know all of this calculation, right?
Yeah. Yeah. Yeah.
So let me just, instead of
Yeah.
writing these in numbers, let me help you with some small transactions. Can I say that he paid how much did he pay? Can I say that he paid US rate, reference rate to the swap dealer?
Correct.
Can I say that he paid Euribor plus 60 to the bank,
Yeah.
and he received So I'm doing it a minus of Euribor minus 20 from swap dealer.
Yeah.
Are you following?
Yep.
So basically, he paid the US rate to swap dealer.
Yeah.
He paid Euribor plus 60 to the bank. This is payment. And this is something that he received. So I'm doing a minus over here.
Yeah.
So effectively, if you look at this, effectively, these E and E will go away. So effectively, his cost will be the US dollar rate, whatever the reference rate would be, plus 60 minus 20. So U plus 80.
Yeah.
Right?
Oh, he's paying U plus 80. Got it. Got it. Yeah. Clear.
Clear, right?
Yeah.
So effectively, can I say that he's going to pay 50 million multiplied? What was the rate?
2%.
Right? So basically 2.8 we can say.
Yeah.
Multiply 90 by 360. Multiply 90 by 360.
Yeah.
So this rate effectively, and I'll tell you the calculation, but then this amount is going to be $350,000. So the idea is that if he borrow it directly from the bank, it's going to be $375,000 versus if he do it directly, it is going to be $350,000.
Mm-hmm.
So effectively, he saved $25,000 in the synthetic swap.
Very clear.
Understood?
Yeah.
And to do this directly, even in one shot, obviously, you should know all the steps. But if you're clear with everything,
No.
and
Makes sense. Yeah.
you can do this calculation right away,
Yeah.
right? So all you can do is you can just think like this after doing this calculation.
Yeah.
You would know that I am effectively Can you hear me?
Yep.
Okay. So he would say that I am effectively paying you plus 80 in this case,
Yeah.
right? And I could have paid you plus 1%. So basically this is you plus 80 bips
Yeah.
from a directly to a indirectly. So the difference is how much of the 20 bips,
Yes.
right? On how much? $50 million. Had he been directly invested into the bank 1%,
Yeah.
in the whole transaction of synthetic borrowing, he's paying 80 bips.
Yeah.
So can I say that effectively he is paying 20 bips overall?
He's paying 20 pips overall. Meaning?
What I'm trying to say is that if
He's
he
paying
had to borrow
USD plus 80, right?
sorry,
He's paying USD plus 80.
yeah. So what I'm saying is that he's paying the US reference rate plus 80.
Yeah.
He's paying in a synthetic borrowing. He's paying USD plus 80 bips.
Yeah.
Right? I'm saying doing directly, he would be paying US plus 100 bips.
Yeah.
So I'm saying, what is the difference? What is the overall benefit?
20 bips.
Benefit is only of 20 bips. You do a subtraction, US plus 100 minus US minus 80.
Yeah.
So basically the effective difference is of 20 bips. multiply 50 million, multiply 90 by 360. So this is, when I say this part, this is just to calculate my benefit on direct versus synthetic.
Yeah.
Does it make sense to you?
Makes sense.
Sure?
Yep.
Okay, if you are sure about this, I really wanted to solve for the second settlement date.
Yeah. Let's do that.
And I want to get some real numbers,
Yeah.
then the assumptions. And then you also tell me if you're comfortable understanding then how much my net benefit would be.
Yeah.
Okay, let's try. Don't you think that creating boxes and looking at each like separately makes our life so much easier?
Yeah. It does.
So it just makes the question a little lengthier to solve.
Yeah.
But then till the concepts are not clear, I think that's the right way to go about it.
Correct. Yeah, I've done something wrong somewhere, but I'll just walk you through what I've done. So the first part is I've calculated how much he has to pay the bank in Europe. So the euro rate is 1.6%. He has to pay 1.6% plus 60 bips. So that is actually 2.2%. So 2.2%, I don't know why I wrote 2.1, but 2.2%.
1 second. I was okay till 1.6% plus 60 bips that is being paid in euros to the bank.
Yeah.
Okay, and what's the next thing that you said? Sorry.
The 1.6 plus the 60 bips, which is 0.6%,
Yeah.
is 2.2%, right?
Yeah.
So 2.2% divided by 4 into the euro notional, which is about 42.319. So he has to pay the bank about 232,754.
Okay, good. So this is much he pays to the bank. Okay, I agree with you.
Yeah.
Then what's the next thing?
Then he receives basically.
Hold on. Let's just also talk about how much he pays to the swap, right?
Yeah. Okay. So he
Or,
pays.
or maybe let's just talk about receipt. Whatever you want to do it.
No. We'll talk about payment. So he pays the USD rate to the swap dealer, so which is 1.9% into 50 million divided by 4. So that comes to about $237,500.
Correct.
Now that if I were to convert in, okay, I've just converted into euros. How much that is using the same exchange rate, which is 1.1815. So that's about 200,422 euros. Okay, we can park that aside. But yeah, so he has to pay 237,500. He receives 1.6% minus the 20 bips, so 1.4%. In divided by 4 into the euro notional, which is 42.3.
Okay.
So that he receives about 148,117 euros.
So far, so good.
Yeah. So overall, he pays 232,754 euros plus 200,422 euros and receives 148,117 euros. So net, he's paid 285,059 euros, which translates to $337,794. Which, if I were to calculate the cost on 50 million euros is about 2.7%. I just did how much he had to pay, which was $337,000, $337,000, 795 into 4 divided by 50 million.
Why did you do this?
To figure out his effective cost, how much he's paying, which is 2.7% USD, which is effectively the USD rate plus 80 bips.
80 bips, it was 100 bips.
No. How much he's paying through the synthetic borrowing.
Synthetic one, okay, yeah. So what will the effective difference would be?
20 bips again.
20 bips again, right?
Yeah.
So which translates to the same amount.
Yeah.
Right. Okay.
Yeah.
So you realize that whether the interest rates were 1.5 and 2 versus 1.6 and 1.9, he end up his cost of borrowing, the savings would still be $25,000. Can you see that?
Yeah. Yeah.
And here, when there is a second case, again it is $25,000.
Yeah.
Right. So the conclusion is the same, that by borrowing in euros and entering into currency swap, Bobis has locked, very important word. Right. This will help you understand that no matter whether interest rates would move, he would still has locked in the price at a cost of US dollar plus for the USD borrowing. Is that okay?
Yeah.
Getting a hang of it, and you're feeling comfortable in solving these kind of questions?
Yes.
One thing that I also want to talk about is, I heard somewhere in between while you were solving that whatever that he paid in euros, you converted that in USD. Right? So here I want to mention that sometimes it's always good to spend another 30 seconds, right? And to really see, first of all, these kind of question should be dealt with creating the boxes, first of all.
Yeah.
My first recommendation. And second, to look at it as a bird's eye view, you should always look at how much I have to pay and how much I have to receive net. First, that will help you solve the question quickly. There will not be any rounding of errors, because when you're going to convert them to different currencies, and then you convert them back to the main currency, there will be at least a $5-10 difference.
Yeah.
And when the option will not match in the exam, you will not feel comfortable taking that answer right.
Yeah.
Right. So always look at what is the overall payment that I have to make. Think about this. Even though we got something in euro, we paid something in euro, effectively it didn't even matter. Didn't even matter. All it mattered was how much I paid in US dollar, basically LIBOR, plus 80 bips.
Yeah.
So even effectively the Euribor was something, and then you calculate something in euros, and then you convert them back to dollars, it was of no use.
Yeah.
But you would not realize while solving the question, because the numbers would be different.
Yeah.
But the idea is, if you extract the euro amount and then the 80-20 bips as a differential, then you will see that they just cancel out each other. Right? That's the reason I made you write these statements, that okay, he paid as LIBOR or a US dollar, I said, right? And then he paid Euribor plus 60, and then he received Euribor minus 20, which is like, if I call this as LIBOR, then LIBOR plus E plus 60 minus E plus 20, which means E cancels out. When E cancels out, it doesn't matter what the dollar or Eurobor exchange rate is and what the euro amount would be. Effectively, you will end up paying LIBOR plus 80.
Yeah.
When we started this session, not today's session, but in general, I'm saying So we said that there could be a classic situation of getting into an FRA, that you want to lock in some interest rates on price, and then this will extend to currencies where you do, let's say, some business on 1st of Jan, and you are about to receive some payment on 30th of Jan, but you don't know what the exchange rate would be.
Yeah.
In such scenarios, you would want to hedge your position to ensure that you again get the same amount that you thought today and will not be different from what you imagined.
Yeah.
Right? It's the same concept. So can I say that you will effectively have to buy the number of contracts again that
Yes.
you can sell to lock in the rate?
Yes.
Right? And again, I would again call this number of contracts as a hedge ratio, similar to what
Yes.
we did. Right? So the simple formula for to that in terms of currency is that the amount of currency right to be exchanged, or maybe I can say to be hedged in a way, divided by the future contract size. It is a simple way to say that I'm going to receive $100,000 in the future. So I have to exchange my $100,000
Yeah.
versus what is the contract size. What is the contract size for a $1 versus INR, right? And if I can get to know the size, I would know how many contracts do I have to sell
Right.
so that I can hedge my currency. Is that okay?
Yeah.
So it says a US firm is due to receive 20 million euros in 90 days for goods they sold.
Mm-hmm.
The firm is seeking to hedge this risk by selling euro futures. So obviously, when he is going to receive this, he is also going to sell euro futures.
Yeah.
Basically, whatever he's going to receive, he's going to sell right away.
Yeah.
When he's going to sell euro futures, what does that mean? When he's going to sell euro contracts, it means he is going to sell the euro after 90 days. And how will he sell? Because he's going to receive.
Yep.
So it is as good as कि मुझे सामने से किसी ने पैसा दिया और वो मैंने पैसे किसी और को दे दिया और
Mm-hmm.
बदले पे अपना INR मैंने ऑलरेडी फिक्स किया हुआ है. Make sense?
Mm-hmm.
Right?
Makes sense.
So it says the firm seeking to hedge the risk by selling the euro future contracts maturing closest to the date the euros will be received.
Yeah.
And the euro USD FX contract size is 125 euros. इतने का एक contract size है. The futures price is this much. The firm will sell the future contracts, obviously promising to deliver euros at the rate of this much, right? So they are not playing role of the currency here. So they say how many number of future contracts required to hedge the asset? Isn't it going to be 20 million divided by 125,000?
Yes.
Right? So basically he is going short. Basically he is going to sell 160 contracts, 160 futures, right? So that he can hedge the position. Now you can
Yeah.
see that at the contract settlement, the firm will deliver euro 20 million and receive obviously 20 million multiplied the exchange rate, which is this much amount. So as
Yeah.
on today, he fixed in the rate that I will be receiving 26.3 million. Is that okay?
I'm just thinking. One sec.
Right.
Yeah, that's correct.
Now, the only challenge over here is that these are future contracts, and we said it is 90 days, but we don't know when our payments are going to receive, right? This question is a simplistic view in saying that, okay, I'm going to get money in 90 days and the future contract that I'm
Yeah.
going, it is also of 90 days,
Yeah.
right? But let's say I'm going to receive money in 95 days,
Yes.
but the futures contract available is of 90 days.
Yeah.
Right? then obviously there will be a risk of those 5 days.
What happens like that basically in those 5 days?
What happens? Is that your question?
Yeah.
So I'm saying that when you have this is t equal to 0 and this is going to be t equal to 90 and this is t equal to 95.
Yeah.
Right? So you got into a contract where you said that you will be selling euro on this day. But what is the risk? The risk is that you are going to receive euro on 95th day.
Yeah.
Right? So how will you sell those euros over here?
Yeah.
Now, again, I can complicate this as it could be, but then the worst case scenario is that you will have to buy from the market and deliver for 5 days maybe, and then he will also have to look at obviously somebody, because you will never find a contract for 5 days as a future contract, so you probably will have to reach out to some kind of a dealer, a OTC product, right? And then in 5 days you offset the transaction. Other way around, you are going to receive money in 70 days, right? And you will have to sell in 90th day. Okay, so when you're going to receive the money on the 70th day, you will get the money that gets converted in dollars will be as of the 70th day.
Yes.
But then you will deliver at a specific price on the 90th day, whatever the price would be, and these prices could be different.
Yes.
Again, your risk.
So essentially we have one of our investments getting monetized in say first week of August. So we'll receive say INR, right, through an IPO, and then but we have a forward contract that is hedged for $100 million notional, but that forward contract expires on 14th August.
Right.
And we have it for a price of say 86.6 USD to INR. Now suppose I receive the INR amount in 1 week before the forward contract expires. Then what you're saying is effectively, so when I'm hedging the INR amount, I will buy a forward, right?
When you are hedging the INR amount, so let's just talk about, are you going to receive in INR?
Yeah, going to receive in INR.
But effectively you wanted it in dollars?
Yes.
So you will sell the INR contract.
Okay.
भाई ये समझो ना इस बात को कि आप you wanted dollars.
Yeah, you're receiving in INR, so you will sell in INR. Yeah.
Exactly. मतलब जो मेरे पास आया है वो मुझसे ले जाओ और मुझे बदले में जो मुझे करेंसी है वो दे जाओ. तो when you are receiving in INR, you will be selling the contracts in INR.
Yeah.
Right. Now you said that you will receive the INR money in first week of August.
Yeah.
But the contract that you got to sell the INR will happen on 14th of August.
Yeah. And maybe let's just take like currency at receiving is 85, but my forward is 86.6 or 86.
All right. So what happens is whatever amount that you receive in INR, now there are three different ways. You already receive in INR at 85, right? Keep the money in INR at 85 rupees only, right? And wait for 14 days. When you wait for 14 days, the INR amount will be 86.5.
Yeah. Correct. Correct.
So to convert, let's say $1, you said that I'll give you 86.5 and you will give, I'll give it to you and you give me $1. Is that correct?
Yeah. Yeah.
But on 1st of August, you actually received only 85 rupees,
Hmm. Hmm.
right? So from your own pocket, you will have to give away 1.65 to again get $1 in hand. That's your loss,
Clear.
right?
Clear.
Again, I can even complicate this much in a way because what you received today, this is 85 and this transition is happening at t equal to 14 at 86.5 and this is time value of money. So the
Yeah.
idea is that you will invest your 85 rupees for 14 days
Yeah.
and then that amount might become 85.5 on that day
Hmm. 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 Hmm.
and
Hmm.
then effectively you will only have to pay $1, 1 rupees extra,
Super clear.
because at the end of the day you cannot be comparing these two numbers at all. Time value of money exists.
Yeah. Thank
Or
you.
maybe or maybe another ways that you know it is going to be 86.5, so you buy another contract,
Hmm.
right? Because you got it 85, you sell it 85 right away and
Hmm.
then you take an offsetting position for 15 days. Well, all I'm trying to say is you can do a lot of things depending
Hmm.
upon which do you think would be the best way to get the maximum amount.
Got it. Clear.
Now the next thing is equity swaps.
Yeah.
Very interesting and something that we understand, we like it.
Hmm.
Again, whenever I talked about any of the swaps or any of those concepts, I always talked about what is my motivation, right? The name equity swaps clearly says that I am swapping the equity,
Hmm.
right? But the question is, why would I think about swapping an equity and what am I trying to do?
Yeah.
A simple classic case is, let's say, okay, let's take this one. So there's a US Iran war going on, right? And there is a US investor who has invested in S&P 500,
Hmm.
right? S&P 500. Now he thinks that the stock market is going to crash or it will go down because of the war,
Hmm.
right? While he also thinks that India is doing great
Hmm.
and investing in Indian markets could be a good option,
Hmm.
right? For now, I'm not really complicating the concept and I'm not really working around on exchange rates. I'm not doing that for now.
Yeah.
But assuming the same currency, the point is that one equity market is going down, one equity market is going up,
Hmm.
right? So one way of doing it that he'll sell everything from S&P market and he will
Correct.
invest in Indian markets. That's a good way to go about it. But then
Yeah.
there are two problems to that. Two problems. First problem is that he might think that the downfall is temporary
Yeah.
and he doesn't want to sell all of his holdings permanently,
Yeah.
right? So that is another motivation of why he would not sell and think about swap,
Yep.
right? And second, getting exposure to Indian market will incur a lot of cost if he sell, We talked about this in some other class, that in case he wants to sell, he'll have to pay commissions and then taxes and then other commissions to get into this market. Right? So basically cost. And third, it could be accessibility. He might not have access to Indian markets at all.
Yeah.
But just by doing the swap thing, he got exposure to Indian markets without really doing anything.
Correct.
And vice versa is also true, that somebody wants to get an exposure to US market without even investing in your market, he got the exposure. Does it make sense?
Yeah.
Yeah. Any questions so far?
No.
Okay. So what we saw is that in initial FRAs and when we do the swapping, I had a risk that the interest rates might go up. If the interest rate might go up, I would want to pay fixed.
Yeah.
Interest rates might go down, I want to pay floating.
Yeah.
That's my motivations. And then when it comes to currencies or currency swap, it was altogether different story. But I'm saying when it comes to getting the equity exposure to different markets, I can have fixed to fixed. I can have float to float. Right?
What is an example of float to float?
Float to float. Again, this is the example of float to float. We don't know the returns.
Yeah.
How much my Nifty would give me return, how much my S&P will give me return, I don't know that.
Yeah. And fixed to fixed?
Right? Fixed to fix could be
dividend?
No, dividends are not fixed. Dividends are not fixed. So basically it is not going to be fixed to fixed per se in terms of equity, but actually fixed versus equity return. Where I can say that I can pay you 3% fixed, right? And you pay me Nifty return.
Yeah.
Right? Where this part kind of a floating leg.
Yeah.
So basically there are effectively three things. One is that you pay fixed and receive equity. When I say equity, basically means equity return.
Yes.
You pay fixed when you think that the market, your return could be the return on equity. And what's the motivation of this? When you think that the return on equity could be too high, so you want to pay fixed and you want to receive equity return. Make sense?
Makes sense.
You want to pay equity and you want to receive fixed when you think that the equity returns will be too low.
Yeah.
In that case, you want to receive fixed. Right? And the third scenario could be that you want to pay equity and receive equity. Where you think that your market will not perform well while other market is performing well. This example.
Yes.
Okay with all three cases?
Yeah.
And you can also imagine that netting will not be a problem.
Why? No, this will have netting, right? Or you're saying it won't have?
Yeah, I'm saying netting will not be a problem.
Yeah.
It means netting will happen.
Yeah.
Right? Just to let you know that it sounds a little counterintuitive, but it works both ways. That let's say I said that I will be paying in Nifty, I will be paying Nifty returns, and I will be receiving, basically this is Nifty standard, and I would say BSC 300. I will receive BSC 300. Right? Let's say this is 2% and this is minus 5%. So I hope you would be effectively paying 7% and receive nothing. Right? So
Right.
when I used to teach this in the class, a lot of people ask me, Ankur, I understand we will be paying 2%, but if this is minus 5%, then effectively I will not receive anything. That's it.
Yeah.
I said no. So if it is minus 5%, so it will be like minus of minus. So you will have to pay it to him if it is minus 5%.
Got it.
Right? Sometimes it's a little difficult to understand why am I paying on a negative return. If it's a negative return, he will have to bear. No, but the idea is whatever I am going to get, I'll exchange it with you. Whatever you are going to get, you will going to exchange it with me. That's the reason it is swap. So he is getting a loss, so he will exchange his loss with me, right?
Yeah.
So netting makes it my payment of 7% to him. Are we clear?
Yeah.
One thing that they mention is that let's say I get into a equity swap versus physically owning a stock. So they say what are the different advantages?
These swaps are standardized or OTC?
Swaps are OTC products.
I see. And there's a risk of default, is it?
100%. 100%. Right. Again, the swaps could be standardized only and only if I'm just thinking. Actually, swaps are not standardized. I should also check this because I don't think that there is a way. I know when I was working in JP Morgan, they have an index called as Jackie.
What is it called?
So there, in JP Morgan, there's an index called as Jackie,
Okay.
JACI, right? JP Morgan Aggregate Credit Index. And they have a swap on that. Right? So they deal with some of the custodians and then banks. So they give the return on Jackie and then they do a swap. But I don't think that is also called as a standardized product. One second. Are swaps OTC? So it says, yes, swaps are typically traded over the counter, which is OTC, meaning they are not exchange traded like stocks or futures. Yes. So they are OTC products.
Got it.
And think about this, right? Even if JP Morgan is doing a swap, it is not being regulated by exchange or SEBI. So yes, it's a OTC product. But then when it comes to big players, they usually don't default, but the risk of default will always be there. Okay. So what they're saying is, when I get into a equity swap, think about this. I obviously getting an exposure to equity.
Yeah.
Right? So what they're trying to contrast over here is that I get into a swap and I get the exposure of equity. So how about that I buy a stock and get the equity exposure versus I get into a swap and then I get the equity exposure? How different are they? So they say that if you get a swap, obviously you will gain the exposure.
Yeah.
As a right, but then you will also avoid tax. We talk about that.
Yes.
You don't have to pay any fees.
Yeah.
Custody fees or any kind of fees, and then avoid the cost of monitoring the physical position, which is it could be any kind of corporate actions, right? Dividend payments, split, buyback, M&A. I don't have to monitor any of those things because all I need is the return on that equity that I'm going to receive.
Yeah.
Okay? But obviously, in disadvantages are that equity swaps typically require collateral. Although in OTC product we say that there are no underlying as in that you don't collateral, there's no collateral.
Yeah.
But then usually it does happen. Swaps are illiquid. As I say,
Mhm.
OTC, had it been some standard products, the liquidity would not be an issue. And obviously, when you are getting into swaps, you are not physically owning the stock, so you will obviously not have voting rights.
Yep.
Is that okay? Clear?
Clear.
So let's do one thing. There's a question coming up. So I would say let's just start that from tomorrow.
Yes.
And I believe, how about, Acha, tell me something. Will you be able to extend for half an hour? I was thinking to start by 9 tomorrow.
Yeah.
Or is it a hard cut at 12:30?
No, so 1 p.m. I have a call. So obviously I can do till then and then do the call, if that's okay with
Okay.
you.
Because I was thinking that it will be difficult to calculate half 3.5 hours, etc. And in the morning, I can also sleep a little bit more. Right.
Yes, even I would
Tomorrow
like
morning.
that.
Yeah. So I'm saying that let's just start from 9 and keep it from 9 to 1 for tomorrow.
Yeah, you will have to keep it till 50, like 12:50.
That's fine. That's okay. That's fine. 5-10 minutes is here. There. It's okay. Right.
Yeah.
Let's keep it from 9 to 1 in a typically. And on Sunday, I was thinking, how about uh, I'm thinking let's just spend at max 3 hours for this weekend at least.
Yeah.
So how about maybe how are you comfortable? 3:30, 6:30?
Yeah. Perfect.
6:30 would be fine, right?
Perfect.
Okay, okay, great. So tomorrow 9 to 1 and Sunday 3:30, 6:30.
Perfect.
Right? Okay, then we'll take it from there.
Yeah. Thanks so much.
Okay, and I just want to know when you open your books, etc. In case you have done that, so whatever you have studied in last 6-7 sessions, are you still comfortable in solving those questions now?
Yeah, very much. Very much.
All right, then I'll see you tomorrow then, Gaurav. 9
Yeah.
9 a.m.
Take care.
All right. Thanks, Gaurav.